Well, first off, let me start off by thanking the Startup School for being gracious enough to invite me here again to chat. And obviously, I want to thank all of you for spending your Saturday morning on such a beautiful day here to listen to me jawbone a little bit. What I'm going to do here is talk a little bit about how Sequoia sees the VC business, more specifically, what we think it takes to build a really great company. What I'm going to do is try to get through the presentation reasonably quickly, because I really want to leave some time at the end for a Q&A. And let me put up my plea now. Think of some really tough, hard questions, the things that you always wanted to know, and go ahead and ask me them in front of 700 or 800 people here. I'd be curious to hear what they are. Before I talk about the business in general, I'll talk really quickly about Sequoia Capital. First of all, how many of you have heard of Sequoia Capital? Just go ahead and raise your hand. All right. I'm not going to spend a lot of time on the history of Sequoia Capital. We were founded by Don Valentine in 1972. We are very well known, obviously, for our early stage business. What is less known about us, however, is that we are very active in both the growth stage business, which is larger, more established companies. More importantly for this crowd, though, we are very, very active in the seed business. We care very deeply about that business. Part of it is self-interest. Some of the greatest companies we've had the pleasure of being involved with started with a $200,000 or $300,000 initial check. So I wanted to make sure folks understood that about us. We have been fortunate enough to invest in 700 companies. We've had more than our fair share of IPOs and more than our fair share of M&As over the last 35 or 36 years. Over the years, we've been known for our investment activities right here in Silicon Valley and up and down the West Coast. And our geographic focus is something that we're almost legendary for. Having said that, we have expanded that geographic focus now to, over the last 7 or 8 years, 3 new geographies. We have significant operations in Israel, in China, and in India. We're still very focused on those geographies. We have separate general partners in each of those offices, but we now have a global footprint. We tend to invest around the world in 5 major areas: services, software, systems, semiconductors, and sustainability. We're well known for the first 4. The last one is something that we've become active in the last 5 years. We began investing in this somewhere in the 2003, 2004 timeframe with our first investment in a battery company called A123. In the last few years, we've made several investments in this area. Now, notice that I don't call it green tech or clean tech. Our view is a lot broader than that. We think of it in terms of sustainability. Some of our investments aren't what you'd call classic clean tech investments, but they do affect, we think, the sustainability footprint of the energy business. Obviously, some of these are names that you've heard of, Cisco and Linear and Apple and PayPal and Yahoo and Google and YouTube. It's easy to associate us with these big, really huge, successful companies, but you need to keep in mind we're early stage investors. When we got involved in these companies, the founders looked a lot more like this. And more importantly, the products look like the products at the bottom. You've got the Apple one there, and Steve and Sandy and Len, the founders of Cisco, with their first Cisco router. Now, over the years, we've had a chance to watch those humble beginnings grow into really, really great companies. And I've listed up here some of the things that we've observed these companies exhibit when they become great. A clarity of purpose, a focus on spectacular markets, a team DNA that's tailored for the job at hand, real operating margins, becoming profitable early and then being very profitable later on, being able to create an inferno with a single match. These are all things, if you look retrospectively at the great companies that we've been involved with, that they've all exhibited. The other thing that's worth doing is looking at some of the mistakes we've made. If you're thinking of building a great company, it's not enough to look at our successes, but go take a look at some of the more modest outcomes that we've been involved with, and you will see things like investing behind momentum, doing things that are very capital intensive, investing in the wrong DNA, repeating history, focusing on small markets. Important to understand the mistakes. We pull this slide up on a regular basis and remind ourselves of that. Now, what I'm going to do here is talk for a few minutes about how you might be able to both emulate some of the great attributes of companies we've been involved with, but more importantly, maybe also avoid some of the pitfalls and pratfalls that were on the previous slide. And what I've done is I've put together a very, very brief how-to on how to build a great company. At a super high level, I'm going to use a metaphor here which our marketing folks at Sequoia are convinced I'm going to absolutely abuse, and if I do, I apologize. This is a picture of a truly great surfer here riding a truly great wave out at Mavericks over in Half Moon Bay. And the observation that we make about this great surfer is he couldn't exist without a great wave. He could have all the skills, he could have a great surfboard, but at the end of the day, unless he's got the talent, the training, and the instinct to know where that wave is going to break, when it's going to break, and then the courage to go out there and ride that thing to someplace really interesting, he's not going to be a great surfer. What we've found over the years is the same is true, quite frankly, for entrepreneurs and their companies. If you want to build a truly great company, you've got to ride a really big wave. And you've got to be able to look at market waves and technology waves in a different way than other folks and see it happening sooner. Know how to position yourself out there. Prepare yourself. Pick the right surfboard. In other words, bring the right management team in. Build the right platform underneath you. Only then can you ride a truly great wave. And at the end of the day, without that great wave, even if you're a great entrepreneur, you're not going to build a really great business. It's a really important point. We, from time to time, hear from entrepreneurs that are very, very talented. They've got a great technology. They've even got an interesting product focus. But if it's not associated with a really large wave, it's very hard to get comfortable investing in them. The other point that I'll make, this is a really important one to keep in mind. This surfer here can only pick the wave and pick how he or she rides it. They can't change the direction of that huge thing. They can't change the shape of it, the size of it. They can't will it to be smaller because they can't ride a bigger wave. They can't change the direction of it. Entrepreneurs are also basically at the will of the wave they ride, and the truly great ones understand that and they respect that. Their differentiation is being able to identify not just the wave, but when it arrives, how it arrives, the shape of it, and they figure out how to uniquely ride it in a way that takes them somewhere really great. So what I'm going to do here is dig into some of the things we think entrepreneurs do in order to select their waves and ride them in a way that takes them to really great places. The first is market insight. It's not enough to ride a great wave. You've got to understand the markets that get created by these waves. The first thing that we look at, and we hope you'll look at as well, is the size of the market you're targeting. Size matters. At a very high level, the first thing we look at is total addressable market. This is how much revenue you could generate if you could get every possible customer to buy your widget at some average price. And the reality of this is if your total addressable market is $100 million, you can't build a $300 million business in that market. What we observe over time is that the challenge of small markets is even deeper than that. Not only can't you build a big business in a small market, scale works against you in a small market. Oftentimes it's hard to build even a small business in a small market. Small markets have issues like customer concentration and lots of competitors and fragmentation. It's not enough, though, to understand the size of the market. You've got to understand a little more about the structure of the market. There's a total addressable market, but you've got to peel the onion and understand which portion of that market realistically can be served. This is the SAM. And you've got to peel it one more time and understand structurally how much of that market can you get. What is going to be your share of market? Something else that matters a whole lot when you're picking a wave and you're picking a market is understanding the dynamics in that market. Are you entering the market early? Are you entering the market late? Is it a quickly developing market, or is it a large established market? What are the trends? What kind of leverage can you have in that market? What's the competitive landscape? The stage of the market matters as well. You've got two columns here. On the left side is the column which are the characteristics that companies exhibit when they join an existing category. These are typically called late market entrants. The dynamics are that the market is usually large already. If it's not, you have to wonder why you're building a company. You've got to be able to leverage price and performance because your customers are a lot more opportunistic. You've got to be willing to live with lower gross margins and a lower market share. And history sort of teaches us that while you can build interesting businesses if you're a late market entrant, the outcome is generally an acquisition, and the legacy that you build as a founder and a founding management team is more about, at best, a single generation reign. Think about Calpana in the early 90s, the Ethernet switch company. Those of us who've been in the networking business certainly remember it as a very important company that created a brand new product category, but they came to market quite late. And in the end, they were acquired by Cisco. They became an important part of the product line, and the founders and investors and management team did well there. But they didn't build a dynasty. Now, if you look at the right side of this slide, what you're doing when you're going into a market early is you're defining a new category. This gives you an opportunity to start when the market has a very, very small size and ride explosive growth. You tend to leverage things like IP and functionality and brand. Your customers tend to be fairly loyal. You're the only solution in town. You can have large market share, and you can have high gross margins, and you can dream about being a financially independent company that someday goes public. More importantly, if you've got all of that and maybe a little bit of luck, you can build a dynasty. The point here is, as an entrepreneur, You can do either the left column or the right column. What you can't do, though, is mix and match. You can't go into a market late and then dream about being a financially independent company, because history sort of teaches us that the dynamics work against you if you try to do that. The next step, once you've figured out the wave in the market, is you've got to put together a compelling offering. Ideally, what you want to do is you want to focus on folks whose hair is on fire. The reason why you want to do that is because folks who are on fire tend not to ask a lot of embarrassing questions like, how long have you been in business? How much cash do you have on your balance sheet? Have you ever had a job before? Frankly, they don't care about that. What they're really looking for is a fire hose. And frankly, they don't even need a very good one. It can leak, not be certified by UL. All it has to do is put out the fire, and trust me, they're going to pay for it. Now, the other important point here to understand is it's not enough to aim at somebody whose hair is on fire. Sell them the right thing. A fire hose is a good idea. Fire insurance is a really bad idea. Number one, you will go out of business if you only sell it to people who are already on fire. And trust me, if you've ever seen somebody on fire, they're not that interested in insurance. An overlooked point about coming up with a compelling product is that the message matters. It's easy to focus on the solution to a real problem and then say to yourself, hey, look, I build the solution and they will come. But the truth is, the world doesn't work that way, especially if you're entering a market early in the wave. A lot of folks may not realize truly what the problem is or what the solution is. So you've got to come up with a very, very short, easy to understand message. You're trying to get talented people to join, VCs to invest, banks to lend, service providers to help, customers ultimately to buy. In order to do that, you've got to get them to care. A lot of folks talk about the elevator pitch as being absolutely key. We totally agree at Sequoia, but we take it one step further. We think ultimately you don't have any time to ramble when you're telling these messages. You may have only 1 or 2 minutes to transmit to somebody, whether it's a customer, a potential employee, a VC, whether it's even worth spending the next 60 minutes. In order to transmit that message quickly, you've got to come up with a one-liner. Here's an example of a possible one-liner that Len and Sandy, the founders of Cisco, could have used. Cisco systems build special-purpose Unix servers that allow connectivity between homogeneous networks. This is technically accurate and totally useless. I don't even have to introduce this. This is how they talked about their company. This is how they got folks to pay attention. You've got to come up with a one-liner. And it should be a warning sign to you if you can't. Maybe the problem isn't simple enough to communicate that way, which has its own issues, or maybe you don't understand it well enough yet, either the problem, the solution, or your customers. But we think it's very important to get this down. So you've got a wonderful product. You're aimed at a really big, high-growth market. Well, how do you win that market over a period of time, keep all the competitors at bay, and build that huge dynasty that everybody wants to build? Well, the answer is you've got to start with an unfair advantage, but more importantly, you've got to pick an approach that builds more unfair advantage over time. Now, in the beginning, you are this little guy fighting that sumo wrestler. The only advantage that you have, trust me, is that you're really hard to see and you're a whole lot faster. Otherwise, he will grab you by the neck or something worse, and you will get hurt. The other thing you've got to leverage is your ability to iterate rapidly. Look at the first few products from these truly great companies. Look at that Yahoo page. At some levels, if you compare it to the internet today, it looks pretty horrible. The same thing with the YouTube page, the Google page. Look at that Pong game. I wouldn't even know how to use that thing. All of these companies shared one thing in common. They didn't wait for the perfect first product. They figured out the minimum functionality they needed to get some subset of the market to care enough about the product to use it, and then tell them what else they needed. And then they very rapidly iterated. We see this time and time again. Don't get it perfect. Get it good enough, get it out there, and then listen very carefully, make changes very quickly. Now, eventually, you're going to attract attention. You get some customers, you win some deals. The big guys are going to figure out that you're in their business, and they're going to try to crush you. We see this time and time again. You've got to figure out how to leverage disruptive opportunities in the market. There are books written about this, but let me net it out. A disruptive opportunity is an opportunity where, for structural reasons, large companies find it hard to compete with you. Structural reasons are not you are smarter. They are not you have better technology. What you will find is big companies have fairly smart people, and eventually they get pretty good technology. Structural barriers have to do with things like pricing. If I've got $1 billion revenue line, and in order for me to compete with you on pricing, I've got to ding my revenue line across the entire business by lowering the price in the few deals, in the few areas of my product line where I compete, I'm not going to do it. Not until you're fairly large, and at that point, it oftentimes is too late. There are also ecosystem things that create an opportunity. For instance, if you are a large internet portal and you want to diversify into the mobile business, it is very difficult for you to do that. Why? Because the mobile carriers get that if they let you into their wheelhouse, it will cause them pain. As a young company, however, what we've found is smaller companies are a lot less threatening, and believe it or not, can get away with things in the mobile environment that a Yahoo, a Google, a Microsoft could never get away with. You've got to find these disruptive opportunities, because if it's a market that's worthwhile, at some point the big guys are going to want to play in it. Now, even disruptive market opportunities won't protect you forever. You've got to accumulate advantage. At some point, you will be a $100 million company, if you're fortunate enough and you've done it right, but you'll still be dreaming. You'll want to be a $1 billion company. No disruption is going to keep a big company from putting you down at that point. You have to have over time accumulated advantages. There are a bunch of them here. You can leverage technology. It's kind of hard. You can leverage design and domain knowledge. But what we found is the most powerful lever are things that have network effect. Business process reorganization, partnerships. These are things that become very sticky over time. As you're thinking about building a business, and particularly when you're coming and talking to Sequoia, we need to understand what subset of this you're going to use to accumulate advantage, because we want to dream alongside you about riding that big wave to something really interesting 3, 4, 5, 10 years down the road, and our experience tells us that you need this. Now, I've gone through a lot of things fairly quickly here. If there's one thing, though, that I want everybody in this room to walk away from, it's the really high-level point of the surfing metaphor. The truism in surfing, my surfing friends tell me, is there can be no great surfers without great waves. That is just as true in the startup business. And you've also got to be able to respect the wave, because great surfers are not great because they know how to make waves go in a different direction. Most of the guys that try to do that end up hurt or worse. It can happen to entrepreneurs as well. Truly great entrepreneurs understand how to identify, respect, and leverage waves. That's the message I'd love to have you take away. So at Sequoia, we are very, very interested in talking to folks who have a vision for finding that next wave. We'd love to help you build the surfboard, assemble a team, get out there and ride it somewhere interesting. If you think you've got a vision for doing that, feel free to drop me a line. I'd love to chat with you about it. So with that, what I'd like to do is open it up to Q&A. Thank you.
I'd like to ask, you said that the entrepreneurs are the people who can identify the waves and then ride them. I assume that there's some of that DNA in your company as well. How do you validate those waves and identify those people?
Well, it is true that a lot of us come from operating backgrounds, and we can leverage that experience. But, truly the way that we try to validate these things is we go out and we talk to the rest of the world about it. The advantage of doing what we do is we have a long sort of tail of former entrepreneurs that understands markets well, and we tend to leverage them as a resource.
Thank you.
A lot of people in here are hackers, and a lot of your talk was basically, it seems like you almost have to be an expert in marketing for a lot of this stuff. And a lot of people start with this simple idea of build something people want and let the market work itself out. And you're talking about all these structural advantages and stuff. And quite frankly, I mean, we're not necessarily thinking along those lines. How can we do that?
Well, they talk about great writers writing about things they know about. I think great hackers, frankly, develop solutions to things they know about. Focus on what you know about and try to find an intersection between that and a large number of folks. If you look, the vast majority of our founders are not marketing professionals. Frankly, they are technical people. The slight extra step that they take is they think, look, there are 10 problems I could solve that are interesting to me. What is the intersection between those problems and things that affect 1,000 people or 1,000,000 people? It takes a little bit of effort, but surprisingly, as human beings, we're not all that different from each other. You may be surprised to find that of the 10 things you're thinking of solving, 2 or 3 could apply to a very, very broad group of folks. Take the energy to find those, and I think you'll find your way towards a big market.
Thanks so much.
Hello, my name is Brennan. I work in the adult entertainment industry. and I was wondering what factors would you invest in that type of company, and also what are some issues you would face as a VC if you're thinking about it, and any advice you would give?
So, I don't know how many of you have ever been in a hurricane. I've been in a few. I come from the East Coast, and I'm going to tie this back in just a second here. You stand on the shore and you watch some of the waves that get created by a hurricane. They're absolutely massive, but they are absolutely unrideable to any place interesting except, the hospital. Not every great market wave is rideable at a super high level. Now, the interesting thing about your business is if you figure out the right way to ride it, which is not at a really highly visible place at the top where you can get knocked off, but kind of lower on the wave, it can be a very profitable and a very interesting company. And you're going to find investors that are going to want to invest in that. But it is tough to ride that kind of wave in the kind of society we live in to the type of outcome that VCs, for instance, like Sequoia, are super comfortable with.
My question wasn't so much about the whether it was profitable as a business, whether it was a viable business. I believe the idea I have is extremely solid and confident, meets almost all of the criteria you just mentioned. But whether or not you guys would have issues in investing in that, and because of public face and stuff like that.
Well, what I'm saying essentially is that we would have difficulty with that, and the issue is that that's a very, very tough business to build into a large publicly traded standalone company because of some of the sort of mismatches between what society looks for in those sorts of businesses and the attributes of most adult entertainment companies. It's not to say it's not a great business, as you've confirmed typically they are, but it is tough for a Kleiner Perkins, a Greylock, and a Cell, a Sequoia to get comfortable that we can invest in a company like that and build it into a large independent company.
Okay. Thank you.
Paul Graham has written an essay where he mentions something about the importance of geographic location for a startup. And you're famous for having invested in a lot of companies, specifically in the Silicon Valley area. I come from Minneapolis and St. Paul, and my limited experience with the venture capital community there is that it's a little weak. And so I'm wondering if you could comment at all on whether Sequoia is interested in funding companies outside of Silicon Valley, or if not, how important you think it is for startups to relocate to a startup hub like San Francisco or Boston.
So there's really two separate questions there. There's a question about fundraising and picking a venture partner and the geographic impact on that. But there's a larger question in my mind of where you really think the best place to build a company is. We're not focused on the Silicon Valley because we think there's some sort of abstract benefit of the Silicon Valley. There's this very specific thing that keeps us focused here, and that is it's a very fertile ground for growing businesses. One of the #1 limiting factors in companies that have great products and great markets is finding great people. You can find a small number of great people just about anywhere. In our experience, Silicon Valley is the easiest place in the country to find a very large number of them. A lot of VCs think that way, so as a result, it's not so much that we don't know how to get on an airplane, because in many of our other pursuits, our late-stage business, for instance, we do get on airplanes, but we understand the value of coming to the Valley. So I guess this is less about a commentary on the quality or lack of quality of VCs in other places in the country. I would encourage you to come here because I think for most markets, this is an easier place to build a really great company.
Thanks.
Hi, I had a very similar question, so I'll ask if you could specifically comment on the question just asked in the context of Europe.
Well, Europe doesn't have an equivalent of Silicon Valley, there's no doubt about it. But there are areas in Europe where there are VCs and there is reasonable access to human capital. And I would focus on those areas. In Great Britain, for instance, there's a sort of a pocket of folks there. And I do think that it's a bit different coming from Minneapolis to the Bay Area versus coming from somewhere in Germany or France to the Bay Area. See, in Minneapolis, that company's core target market is likely still going to be the U.S. And so they're not really putting a whole lot of distance between themselves and customers by moving from Minneapolis to the Bay Area. When we talk to folks in the UK or in other parts of the world, we tell them, look, it'd be great if your market were in the United States for you to come here to the United States, and if you did that, come to the Valley. But most folks don't build companies in, for instance, the EU to go after the US as an initial market. They focus on the EU, and if that's the case, my recommendation is to find the best place in the EU so that you don't get too far away from your customers.
As a slight follow-up, would you then consider funding them if they're going to stay there?
We have done, probably in the last 2 or 3 years, 2 deals that way. We don't do it out of the U.S. office. We do it out of the Israel office because they fly through London and Germany as they're coming to the States. It's tough. It certainly won't be 2 folks in PowerPoint. There's got to be a little more to the company in order for us to get involved. But it's doable. Frankly, what we'd really rather do is help you find a partner in the geography that you're working in and work with them as the early stage investor. And if at some point it makes sense for us to become involved, then get involved at that point.
Thanks.
As you were speaking about waves, I wanted to get your opinion of where do you see the next stages of monetization on mobile and mobile across other apps, and also widgets, and where the next space you see these apps are going to go to. Do you see it moving beyond the whole sponsored to other models of monetization?
Well, first of all, you've just talked about 2 very, very large waves, the social media wave and the mobile application wave. Both have difficulties in monetization. I happen to be on the board of companies in both those categories. I can tell you both have their difficulties from a monetization standpoint. I think the key thing in the case of the mobile business is to understand the complexity of the ecosystem. There's an obvious way, frankly, I think, to make money in that ecosystem, which is to offer some form of payment support. And you've already got a sort of a payment relationship with the carrier. You've got your phone with you just about everywhere you spend money. The thing, though, you've got to understand is the carriers have figured that out as well. And so it's probably not a great place to go. So the places where we try to invest in are in the most obvious applications where folks are likely to spend money. And if you look at that, it's social style applications or gaming applications, and indeed we've got investments in both those areas, and we're beginning to see the early signs of traction in both those areas. The social media space is a much more complicated environment in some ways because there really isn't a business model around widgets. Widgets grew up in an environment where things were basically free, and we played around. I'm on the board of Rocky, and we've messed around with every manner of non-advertising monetization of widgets. Maybe someday we will find a way to make that work, but right now the focus is on building new and interesting ad units in that space, and in that area it's becoming a very interesting business, mainly because of the huge amount of time that very important demographic groups to advertisers are spending in the widget space. So my guess is the first revenue wave there is absolutely going to come behind advertising. Having said that, we've seen glimpses now of applications that wouldn't make sense in the absence of social media, but truly only makes sense in this context of the Facebook and MySpace and High5 and Bebo. Those applications may have some interesting monetization options. I'll give you one example, back to gaming. A game in a social environment has a huge opportunity to leverage things like digital goods, as an example. And we're seeing the beginnings of that happening right now. And we're looking at companies, and we know there are a lot of entrepreneurs out there. If the first wave is advertising, the second wave in the social media space very well may be digital goods. And I'd love to talk to you or anybody else here if you've got some ideas about that.
I'll give you 2 hints since you've been so valuable. Think, make the users and the developers money, and think savings for the enterprise and the companies. Because the mobile guys opened up T-Mobile and Verizon for 2 reasons. They don't know how to make this stuff. They don't mind charging 10, 20, 30% like PayPal's does, and just collect the money.
Let's chat after the meeting. Okay.
Yeah. I was having a more general question about how you figure out your startup is worth what it is in the future. Like you said, you have to figure out what the structure is, and then the share of the market. My question is, if you're doing a startup and you figured out kind of the structure, and you got some customers, and you got a good idea, and how do you figure out what will happen in the future to figure out what's the share of market, and how you raise money for it?
It's a really good question. It's a particularly tough area. For better or for worse, we don't like top-down sort of analysis. We tend to like bottoms-up analyses, and what we really respect are very powerful proxies, analogies, metaphors, some way to tie the problem you're solving back to money that's already being spent. And so what you do is you sort of look at the problem, and nature abhors a vacuum. What we find, there are some folks, even in really early markets, that are spending money on the problem. You start with that, you use it as a proxy, and you extrapolate from there. And if you can come up with 2 or 3 reasonable approaches, they're not going to be perfect, to do bottoms-up analyses, you can have some confidence on, you're not going to get it down to the number of hundreds of millions of dollars, but you'll tell the difference between a $1 billion market and a $100 million market through that approach.
What if there is very few in the same area?
I'm sorry, could you repeat?
What if there are very few people that are already doing what you want to do?
Well, sometimes that's a wonderfully positive leading indication. it makes it really tough to size the market, and we look very, very closely at the entrepreneurs and their background then because it's a huge leap of faith. For what it's worth, we find it tough without some form of analyses to invest. We've done it, and in a few cases it's worked out. But if you're so early that nobody is solving the problem, you do have to ask yourself the question, is it a hair-on-fire problem?
Thanks.
Well, thank you very much. These were wonderful questions. I appreciate your time.